It's Thursday, March 17th. Easy day to remember because it's St. Patrick's Day.
St. Patrick's.
Don't drink too much
That's why-
green
right,
beer
got a little
or
green
Irish
here.
or Irish whiskey today, please, please. And I have a green watch.
So you aren't going to get pinched.
So I'm not gonna
Julia was the only one who wasn't wearing green in our office, and she, I understand, during the show she went out and got something green.
She did. I think she got tired of being pinched.
So there you go.
Yeah.
So
there are changes that go on with portfolios that are sometimes like changes in a house.
Yes.
Meaning you have some cosmetic changes in your house to make it look better, painting outside, maybe painting indoors.
new carpet.
Something like that. Absolutely. But then there are foundational changes.
Right.
And what we've been doing with our portfolios, or your portfolios, have been foundational. Lots and lots of changes.
This week, we recognized, started looking inside portfolios in the certain sectors we in, and we focused on energy inside the portfolio. And beginning last November, we began to add energy through ETFs and certain managed positions. And we've, for the most part, in most everybody's portfolio, we've had a good run up in that.
Yeah.
But when you have an energy swing that a barrel of oil could go from $120 down to $92 back to $100, and we all ask each other, why is it doing that? And you can't explain that. And you have all gain. There's the vast majority of all our positions in that sector
that don't have gains.
Have gains. We decided that volatility, because we do believe that energy is still going to do this swinging. Let's take some gains off the table and reposition.
And by taking those gains, it also reduced pretty substantially the risk within the portfolios.
Right.
Because the risk that these investments were carrying were twice the risk of the S&P 500. So it just made sense for us to do that. And while we were doing that, we also had a really substantive conversation with Phil Orlando Friday of last week, I think.
Yes.
And his outlook was that there's a strong probability that we're going to see another downturn in the market at some point prior to the midterms. So growth investments are going to take it even further, get hit harder in the chin, I guess a better way to say that. And we decided to reduce our exposure, which we've been doing throughout the year, in growth investments into value investments.
Into value. So again, from an energy sector, not only the gains, but that sector, if you had ETFs or a managed position in that, we have moved that to other positions. And then we had focused on growth and moved those to value and raised a little bit more cash, not a significant amount of cash. We have also said to ourselves that we have a range in our mind that we think is the comfortable range to be in, somewhere in the 60% of equity range down to a 40% equity range. And that's on an average. Everybody is a little different, but that's the range we wanted to be in. We want to be more value than we want to be growth oriented, and we want to have a little more cash than we normally have. And I would say on average, each portfolio is in the 20 percentile, somewhere in that range in terms of cash.
Yeah, the bond market is still very iffy because we're in a rising interest rate environment, which is never positive for most bonds. So we've just reduced our exposure there also, and cash is still providing a small positive versus having losses in some bond funds.
If the world can see some sort of resolution, some sort of peace, some sort of stop the war in the Ukraine, and we seem to think that would last, we probably would begin to nibble back into the portfolio. But as long as there's shelling of hospitals and maternity wards and schools, we think the risk of further market decline because of what we have to face and what the Ukraine people are facing each and every day is carrying a high risk. We did get some good news, believe it or not, yesterday with the Fed saying that they were going to go up 25 basis points and it would be 7 increases this year. So they gave us a path to focus on. So now we have a roadmap, and the market likes to have a roadmap. So we we're playing in the ballpark, in the field where we think we should be. We're looking at things each and every day and week and massaging and then changing it.
Yeah, and in that ballpark, we're not looking for home runs, we're looking for singles.
We're looking
Just
protection and singles is
Yeah.
what we're looking to do at this point in time. If you would like to have a conversation, we're talking with our clients each and every day. We're having Chelsea follow up and meetings, but call our office. We'll have a conversation. We'll meet with you. We'll Zoom. We'll do whatever is best for you. We got a lot of good things and exciting things going on. We still remain positive, but we are optimistically positive and very cautious. We do that because we know it is your money.
And your money matters.
We'll see you next week.